Ladies and gentlemen, distinguished speakers, dear audience, it is my utmost pleasure to greet you all the second day of the 2024 Financial Stability Conference, organized by the Magyar Nemzeti Bank, the Central Bank of Hungary, jointly with the Center for Latin American Monetary Studies and the Official Monetary and Financial Institutions Forum. My name is Katinka Szász, and I'm honored to be your host today as well at this event. If you missed any of the speeches or you would like to rewatch our sessions of yesterday, you will be available to rewatch the whole conference on the official MNB YouTube channel in the coming week. Today's agenda opens with a keynote presentation delivered by Mr. Ádám Banai, Executive Director responsible for monetary policy, financial stability, and foreign reserve management at the Magyar Nemzeti Bank. Mr. Banai, the floor is yours.
Thank you very much. Thanks for the organizers. Not for the invitation because they didn't have any other chance, but for organizing this whole conference. I think the first day was very good. I enjoyed the part I could join for. I hope all the other guests enjoyed the conference. So thanks. I'm really proud of my colleagues to make it happen here in Budapest. And in my presentation, I will talk a little bit of economic history or financial history of Hungary, because it is the 100th year of the Central Bank of Hungary, as you heard. So it was to give you a little bit of overview what has happened in the last 100 years of Hungary, although I will don't go through the whole 100 years. So just to give you a little bit of background, for sure Hungary was under Habsburg rule for many years, and in the revolution of the 19th century, that was the first when it happened that the Hungarian nation wanted to have an independent central bank, although the revolution didn't pass, but the initiative to have a central bank was started at that time. And for many years, the central bank for Hungary was the Austrian National Bank, and after that, the Austro-Hungarian National Bank. And the building of the National Bank of Hungary, which is under construction, so not this one, was the building of the Austro-Hungarian National Bank in the last 100 years. And what is interesting for our economic history that in the early 20th century, there was a big boom for establishing financial companies. So that was the first sign of a financial cycle in the Hungarian economic history, when thousands of banks were established. And that was the first time in the Hungarian economic history when setting up new principles was on agenda, and there was a thinking of how to regulate banks, although it was very preliminary, but the thought was born that time, and the main idea behind was the prevention of any crisis in the economy. So it was very similar thinking that time what we have today, and also a financial authority. The financial center was established in the early 20th century, but for sure, as you know from the history, there was the First World War, so we couldn't really avoid a big crisis that time. So although we tried to be prepared for a crisis, we couldn't avoid it because of the First World War. So there are two lessons from this story. The first is prevention is the most important. The second is that you should never lose a war when you are in a financial cycle. So this is how we see the last 100 years, and the Central Bank of Hungary was established after this crisis time in 1924, and a new currency was introduced in the Hungarian system, and we started our history. And for sure, this history was very interesting, very long, so 100 years. So I pressed a little bit the fast forward, and you know, after all, we had a Second World War, then a communism transition crisis in the banking sector, and we got to the global financial crisis, which is more important in this case for us. And why it is very important? So first, I started my career here at the bank at 2008. So I participated in the Central Bank of Hungary stories in the last 15%, which is quite long. And second, the global financial crisis opened a new chapter for central banking, not just in Hungary, but for central banking globally. And why it is opened a new chapter? So let me tell my story. When I started here, I started at the Financial Stability Department in 2008, and what we know that time, or what we knew that time, was that financial stability is essential to reach our price stability goals. So saving financial stability is important. I think that was all what we knew that time. Financial Stability Department was not quite very important in the Central Bank of Hungary, but it was very similar in other central banks. But that time, we realized that financial stability is more important than we ever thought before. And what is very crucial that we understand that there are certain episodes of economic history when financial stability, so the goal of financial stability and price stability, maybe cannot be reached at the same time, and you have to choose between them. So it was very important to see what decisions you made, and it was very important to understand that sometimes monetary policy is hindered by the lack of financial stability or by the fact that you have to reach financial stability because financial problems with financial stability is more abrupt usually than problems with price stability. So first you have to reach again financial stability and then price stability. So what I will do in the next couple of minutes is telling you a kind of case study about Hungary, how we dealt with the global financial crisis and how we dealt with the last years of crises and what was the big difference of the two episodes. And the short answer is the macroprudential policy. So what has happened in Hungary before and during 2008? Before 2008, Hungary was one of the example countries of FX lending. So we knew the problems before of dollarization, we knew the problems before eurozation, but in the region, in the early 2000s, in many countries, FX lending was the most dominant product in bank lending. So as you see on this chart, especially on the household side, but also in the non-financial corporate side, most of the customers borrowed in foreign currency. 70% of the households, about 60–65% of the corporate. But it is important to know that among the corporates there were many SMEs who didn't export that time, so they didn't have a natural hedge against this type of risk. So there was a huge reliance on FX loans, and there was a huge risk in the balance sheet due to FX loan. And the main reason behind it was very easy. So there was a big difference of interest rates between FX loans and Hungarian foreign loans. From time to time, it was 5–6 percentage point, which is very big burden for the households. So they thought that borrowing in foreign currencies not very risky if you compare it with the difference of installment burden. And also, many customers thought that we will join the Eurozone very abruptly, so this risk will be eliminated by the fact that we will have a euro. But let me emphasize again that they borrowed in Swiss francs, so Swiss franc-euro exchange rate was still a risk for the household. And what was the result of it? There was many different results. So banks should be capitalized. Again, there were huge liquidity needs for bank, FX swap tools, so many different. But what I want to focus on is the room for the monetary policy. And it is very good to compare the monetary policy of the Swiss National Bank to the Hungarian National Bank that time. So what has happened? The Swiss National Bank, just at the onset of the crisis, when everybody thought that inflation will go down very abruptly and the banking sector will need liquidity, the Swiss National Bank abruptly decreased interest rates. What was the reaction of the Central Bank of Hungary? Due to the problems with the exchange rate, so the Hungarian foreign exchange rate depreciated a lot because of the risk, the Central Bank of Hungary had to increase interest rates. And it was not because of, mainly not because of the inflation, but it was because of keeping financial stability. So without keeping the exchange rate relatively stable, we would have faced a much bigger financial stability issue, although at the peak of the crisis, NPL ratio for households was around 20%. So we still could not avoid problems at the financial system, but at least we could slow down and find other type of solutions to somehow save the stability of the financial sector. So it is a clear example when the monetary policy, the first goal of the monetary policy, so the price stability, go against financial stability. And since the effect of financial stability can be very abrupt, so collapse of a banking sector can be in a few days. The price stability is a longer term issue. You have to choose financial stability, but it goes against your monetary policy goals. Because of this lesson, what we have learned, because of this experience, we were and we are, I think, the front runners of macroprudential policy. So we set up a framework of macroprudential policy. I know this slide is quite complicated, and I promise I won't talk about all the tools we are using because it's very complex. But we decided to kind of monitor the whole balance sheet and off-balance sheet items of the banking sector, find out all the risky points, and regulate all the risky points. For first, I remember, and the situation is still a little bit the same, that all the banks were complaining about how complicated it is. They cannot really meet them. We ruined the business of the banking sector, but we decided to prepare the banking sector for the next crisis in any price. And just to give you an example, although it is a little bit one-off, but last year the return on equity of the banking sector was about 23–24%, and before it was also in a 10-ish territory. So this underlines the fact that with this framework, they can be also very profitable, and they can work in this framework as well. And there were two big pillars of the framework. First is the liquidity position of the banking sector. This is somewhat a Hungarian phenomena in the sense that for sure we have LCR and NSFRs for all the Basel countries, but we have very specific Hungarian type of regulations as well, which were reaction for those type of risks what we faced in the global financial crisis, and what can be a little bit regional specific in the sense that here are many big banks, subsidiaries of many big banks. They're working a little bit differently here than in their home countries. So for this reason, we introduced a many different liquidity ratios. And we introduced them for another reason, because what we learned even 100 years ago is that we have to be prepared, we have to avoid risk. So we could not wait for, in some cases, wait for the Basel regulation, introduction of CR, but we introduced our regulation before the introductions of more global type of regulation. And the other pillar was the so-called borrower-based measures. We introduced DSTI and LTV regulation, and we introduced them in a very specific way, in the sense that that we differentiate the STI ratio between different currencies, and later you will see we differentiated them by interest rate fixation period. What is the reason behind it? What we understood during the FX lending crisis is that risk should be borne by those who understand and have the opportunity to manage them. And most of the real economy, either on the household or in the corporate side, are not in this position. Even corporates, even SMEs don't understand this risk and don't have any tools to manage this type of risk. So this is why we decided on using a heterogeneous type of borrower-based measures. And the results talk to themselves. So we can compare the banking sector in 2008, just before the global financial crisis, and in 2023, so the latest figures. That time we had many reds, many risky part of the banking sector, and today I wouldn't say it's risk-free because it's banking, but it is as close as possible to risk-free. So today, and also it was the same during the COVID and during the onset of the war of Russia against Ukraine, we didn't have to be afraid of this type of risks because we prepared for crises. So if we go a little bit closer to one phenomenon, which is the interest rate risk, let me say some words on it. So why we decided in fixation of mortgages? So for sure, it gives a predictable instrument path for the households, which increase the shock resilience. They easily understand it. And it doesn't mean, I think it's very important, it doesn't mean that it is the cheapest version of loans for them. For sure, ex post, it is possible that a variable rate mortgage would be better than a fixed rate one. But the whole idea behind it is the risk, because if it's fixed, if it's predictable, they understand the past, they know what to prepare for. For sure, it is possible that at the end of the day, it would have been better to choose a variable. But households, as they cannot really manage the risk and they cannot really understand that type of risk, what is important to be predictable and to be able to prepare, to build up their saving path, their spending path on that predictable part of their whole budget. So this is the idea, and for this reason, we think that it's worth to take that risk that at the end of the day they will have a little bit more expensive loan because they understand the cost of that loan. So this is why we chose rate fixation. And we used different tools I will show later, and we had very good results in that. So as you see, in the last 6 years, about 90% or more of the loans issued in Hungary, mortgage loans issued in Hungary, were fixed rate mortgages. So this is why we were able to to increase the interest rate during the last crisis, and during this inflation period. I will show you later the numbers, without any hesitance on the risk we have in the balance sheet of the households. And this was clearly a big topic in some other regional countries, but we didn't have to face it. And what we have done, as I mentioned, we had the borrower-based measures. So you can get a bigger loan, a higher DSTI, when you have a long fixation for the loans. This is the essence of the borrower-based measures. We also introduced a mortgage loan funding regulation, which means that we a little bit force the banking sector to use more mortgage bonds, to have more fixed rate long-term funding product. We also introduced the so-called consumer-friendly housing loan, which is a consumer-friendly product in the sense that it's more understandable and more comparable between banks. And part of this consumer-friendly product is that it has a long fixation, which means that when you choose the long interest rate fixation, you will have a comparable long-term product, which you can easily understand. You can compare between banks. So for this reason, it was very successful and very popular among households. And also, we had many communication campaigns towards the households. And we were among those countries which had a long interest rate fixation for most of the portfolio. And this is why, this is why we were, and I skipped this slide, this is why we able to do that during the crisis and during the, after the onset of the war. So in Hungary, there was a very huge inflation. There was a high volatility and big depreciation of the Hungarian forint, and some other type of risk. I don't want to emphasize those, sorry. But what is important, that we could have a very fast increase of interest rate. At the top, it was 18%. Just imagine when you have a variable rate loan, what you, as an initial interest rate, with an initial interest rate of 4-5%, and the central banks increased the rate for 18%, which would have mean for a variable rate loan about 20-22% interest rate. So in installments, it means 100 or more % increase. But we could avoid it because of fixed rate loans, which also meant that when we had to increase the interest rate for financial stability, market stability reasons, or purely because of inflation, because inflation was more than 25% at the top, we could do that. So in this sense, macroprudential policy could prepare the banking sector to meet this crisis as stable as possible, to avoid this type of tail risk, and to make a room for the monetary policy in crisis time. So our experience for the macroprudential policy is that it is very important, it is very useful to avoid those type of crises what we had after the global financial crisis. I have to emphasize that time for 5 years, the banking sector was adjusting for the new for reaching a new stable position. This 5-year adjustment meant that for 5 years the loan book decreased for the financial sector, which had for sure quite strong real economic effect. We could avoid that type of situation, which means that the recovery of the real economy can be much faster, and we can reach the price stability goal as well much faster than before. And I have to underline that after the peak a year ago at 25%. The latest in inflation, the latest figure for inflation was 3.8. So it's quite a big drop. And we think that a big part of this story is the macroprudential policy. And for sure, we don't stop, because we know that we have to be prepared, we have to prevent this type of risk. So this is the reason why we introduced the systemic risk buffer for the banking sector for the commercial real estate loans, because what we see is that commercial real estate can be, or probably will be, the next risky product, not especially in Hungary, but we see some signs in the US and Germany. So this is why we introduced the SRB. And this work this work is reflected by the fact that although we have a quite tough economic environment, in the sense that in the last 2 years we barely had any growth in the real economy, the NPL figures are very stable and on a low level. So this proves, I think, that we had done the right things. And I think this case studies shows the importance of macroprudential policy. It shows that our thinking is very similar that we had 100 years ago, and what we will do probably in the next 100 years. We are very proud of it, and I think it's a nice example for all of us to follow. So thank you for the attention.
Thank you, Mr. Banai, for your presentation. Our first session today focuses on the effect of technological change on liquidity and founding stress. The session will start with the keynote presentation of Mr. Manuel Ramos-Francia, Director General of the Center for Latin American Monetary Studies. Afterwards, we will hear the presentation of Mr. Efraim Benmelech, Henry Bullock Professor of Finance and Real Estate at the Kellogg School of Management, Northwestern University. Ladies and gentlemen, please welcome them.
Hello, good morning again. So this is going to be a story about monetary macroeconomic management. As you know, Latin American countries are small open economies, and at times during the last 4 decades, for different reasons, open economy monetary management has gotten to be at times very complicated. You all know the story. It's a textbook story of the 80s and 90s, many countries incurring in balance of payments crisis. All the narratives concerning speculative attacks in the 80s, and then all these narratives about sudden stops in the 90s, which are very well-known macroeconomic topics. Probably had a lot of their origins in macroeconomic management in Latin America. I would say macroeconomic mismanagement. So the narrative in terms of capital flows volatility, which is the channel, the mechanism through which shocks enter or are passed on to the domestic economies, the nature of those has changed quite a bit. Again, we begin perhaps with, in the case of Mexico, think about this in the tequila crisis, was clearly a problem of fiscal dominance, a problem that resulted in a balance of payments crisis. And, of course, all the discussions that followed with the fund and with the US Treasury concerning the backstops to be negotiated, and, of course, all the correction in terms of the macroeconomic stance, not only the monetary stance, but also the fiscal stance. Then the narrative changed. These countries started to put their economies in order, especially a very important fiscal retrenchment. They changed the way they managed, let's say, in their open economies, capital flows. Basically, they changed, most importantly, their exchange rates from target zones or fixed rates to to floating rates and basically imposed inflation targeting schemes. And then we still had, nevertheless, some, at times, important capital flows volatility. And I remember that the stories at the beginning of 2000s, with much of these countries already in order in terms of their fundamentals, changed from fiscal dominance or balance of payments crisis to stories of incomplete information, asymmetric information, informational cascades, and so on, which basically try to explain away or try to explain the fact of this capital flow volatility, where the emphasis was no longer in macroeconomic management in those countries, but the nature of what gave way to this type of herding or volatility behavior on the part of financial market participants in these countries. So along came the global financial crisis, and there was another very important change. We know that up to the global financial crisis, it was banks, the main players, which had very important market-making activities in this type of countries. We all know the stories in terms of the very important market failures and all of the regulation effort, international regulation effort concerning trying to make the banking system much more resilient. And as a result of this, one part of this effort, as you know, for example, in the US, certainly limited the market-making, let's say, activities of banks in domestic financial markets. We all remember the Volcker rule. We all remember the prohibition or the very important limits on proprietary trading and so on. So another actor, another type of player, came in and started, of course, being the dominant players. And these dominant players have been the global asset managing companies or global asset managers. So we still see, as we will see in a slide, that not only have capital flows, even with much better fundamentals to the region, especially bond flows, have not only the volatility subsided, but through time it has even increased. And this does not certainly reflect any problem in terms of fundamentals, but the problem goes somewhere else. There was a tremendous discussion during the first years in the wake of the financial crisis concerning capital inflows and how through different exchange rate regimes, whether these countries would be accepting either important real exchange rate appreciations, or whether they would be fixing the rate and passing on to their own economies through these fixed rates, the monetary accommodation in the advanced economies. But the narrative changed. Basically, I can give you the date, which is in May 2013, when at first the chairman of the Fed announced that at some point there would be an end to the quantitative easing or the bond purchase program in the US, the very famous taper tantrum. And from that point on, basically you will see that the story changed from currency wars and tsunamis in terms of capital flows going into these countries and basically appreciating the real exchange rates to a much more defensive position in terms of the possibility at some point of the possibility of extreme capital outflows. And of course, when you have good fundamentals in your economy, as basically all of the big Latin American countries did at the time, it was very difficult to defend because you don't have basically any reason to have an important fiscal retrenchment. You don't have all that reason also to have monetary, let's say, retrenchment, because your fundamentals are in order. And basically, the whole shock is coming from somewhere else. And the point here is basically that in order to try to understand this further, you have to go into the nature of the participants of these players in domestic capital markets in domestic bond markets to try to understand a little bit better this volatility. And this is what we will do in this exercise. This, again, comes from being directly, when I was at the board of Banco de Mexico, on how we started to learn about this volatility, trying to go to the root of the volatility and how to deal with this. Let me just very briefly tell you that, for example, the nature of the discussions with the fund changed dramatically from conditional, let's say, facilities, these Article 4 consultations, all of these, let's say, type of programs that were put in place because of balance of payments crisis, to, given that there was still, even with the correction of fundamentals, an important capital flow volatility, to another type of facilities in the fund, for example, the flexible credit line, in the sense of trying to put incentives to keep on managing the economy appropriately, but have liquidity in case there was some problem in terms of stress in domestic financial markets, in particular in bond markets. So let me now go through what we learned and how central banks have been dealing with this situation. So we go to the first slide. Basically, we have, as I was commenting, a striking fact, which is there has been a change in the nature of capital flows to emerging markets. And in particular, in the case of Latin America, we will see that bond flows have been increasing in terms of their volatility. And basically, I think that there is a consensus that two important factors have contributed to this. One is the shift from banks to global asset managers, as I was commenting before, and two, the rise of passive investment and of automated trading. And we'll see how that has impacted, or how we believe that has impacted basically capital flow management and overall monetary management in this economy. So we see here on the right-hand side the share of emerging markets bond holders by type, and we see how there has been a very important increase in these non-bank financial intermediaries. And basically, these are global asset managers. And on the left side, we see the total volume of assets under management, and we see a very important increase in ETFs. ETFs can be both active or passive, as most of you know. In the case of, particularly the case of bond flows to Latin America, basically there has been a very important increase in passive investments, in particular in passive ETFs. We have seen that there has been an eightfold increase since 2010 in this type of instrument. Now look at the net weekly bond flows for 5 countries, which are the 5 largest ones, with the exception of Argentina. We have Brazil, Chile, Colombia, Mexico, and Peru, and I will in a moment say why we chose those countries. And we see clearly there are 2 things to notice here. One is a very important increase in volatility, and second, that episodes of dramatic capital outflows have increased. And we can see here at least 5 episodes. One is basically the lowest point was September 15th, 2008, Lehman. Then we had the Euro crisis, the day that 10-year bonds were downgraded very importantly in Italy and Spain. The Euro crisis, then we have the taper tantrum, May in 2013. Then we had Brexit in 2015. And then we had COVID-19. And basically, we see that, again, the volatility and the magnitude of extreme negative events have been increasing over time. And as we will see, basically, EMEs are, in that sense, vulnerable in 2 dimensions. One is the nature of the players that are participating mainly in their financial markets. And second is, of course, the global financial cycle. So in this, basically, we have a little bit the description of what's going on. All of this description takes place is circumscribed within a global monetary game. We see 2 players, the central banks. Of course, they take decisions in terms of the monetary stance in each country. When you're a small open economy, you always have to look at what the core country, in the case of Mexico or in Latin America, is mostly the US, is doing, and then decide in terms of what stance you want in terms of a relative stance with the core country. And we see here there has been a very important increase, as I was commenting and showing you the numbers of global asset managers. And let me say three things about this. One is, as many of you know, there are important issues concerning principal-agent problems in terms of these global asset managers. This is well known. It has been very studied since probably around 2015, 2014. And basically, the point is that there is some distance between the fund owners and the fund managers. And there's only imperfect monitoring. So what device is usually used to monitor the performance of the fund managers? Well, usually it's a comparison of their performance against their peers or against an index. And you don't want to be the worst performer, certainly. You either get a reputation hit, you'll get fired, and your fund will certainly be subject to redemptions. So that makes everybody in this situation very much adverse to ranking last. And this aversion to ranking last certainly yields very important incentive to act in a herd-like behavior. We know that these global asset managers, the main difference between banks is these are non-leveraged players, mostly. These are open-ended, non-leveraged funds. They are outside of the regulatory perimeter, and very importantly, they're subject to basically what amounts to unrestricted redemptions. They certainly cannot afford the speed with which they can accept redemptions, given the nature of their portfolios. For example, they have, in many cases, 10-year bonds, and yet they offer immediate redemptions. So these are some of the characteristics that these players have. On the other hand, you will see that basically there is an important change in terms of what banks used to do from active to passive investments. And most of these passive investments, or a lot of them, done through automated trading. And basically there is an important concentration in two things. One is there are big players, very big players that have a lot of the instruments, that have a lot of the bonds. I'm thinking about players like BlackRock or Vanguard, not only in terms, for example, of the US equity market, but also in terms of the bonds that these Latin American economies issue. So there is concentration. There is this structure of industrial organization in this industry where basically you can think of as there are big players, leaders, and followers. And their investment strategies are very much alike, not only because of the aversion to ranking last, but also because the big players certainly have a lot of comparative advantages during risk analysis and so on. And so many global asset managers have very much a comparative advantage, the big ones, in terms of deciding what instruments to use, and they've been choosing ETFs. So there's concentration in terms of players, and there's a concentration in terms of instruments. Of course, that leads to crowded trades. Then we have that a lot of the instruments that they use for investing are algorithms. They do the trading through algorithms. But this is a very important discussion, and one that was followed very carefully by the board at Banco de Mexico and other boards in these central banks, which is, it seems that the discussion for a few years was that these automated platforms, these electronic automated anonymous platforms, through which algorithmic and also high-frequency trading took place, seemed to increase the volume in normal times. It seemed that there was including or a better price discovery process. It changed the nature of the market. It seems like made gains in terms of transaction costs for trading and so on. But the point is that these algorithms certainly behave very differently when there are important conditions of stress in markets. And many of them include these famous kill switches, which is if the movement in the price of the asset is by certain magnitude, it kills all operations. So basically what this amounts to is that under conditions of extreme or acute stress, algorithm-provided liquidity dries up very, very quickly. So we have all of these elements. The aversion to ranking class, that is, usually leads to herd behavior. We have a concentration of players, and we have a concentration in terms of instruments. We have crowded trades. And we have basically the issue that under stressful conditions, algorithms usually do not provide liquidity. They are net demanders of liquidity. So that's a big, big problem in terms of this type of markets. And the third element is that EMEs, as you know very well, don't have the fiscal power that, for example, the US has. So their bond markets are certainly much smaller than, for example, in advanced economies. So their markets are certainly thinner and shallower. So two things that come out of this is the increase in liquidity risk creates incentives to accumulate reserves, and I'll go that into a moment, which is difficult or complicated in the context of these countries being fiscally constrained. It is expensive to accumulate reserves, as most of you know. There are certainly interest rate differentials, and there is a cost to funding the reserve accumulation. And two, it also makes it necessary in some cases to be supported by liquidity provision from a core central bank, as I will mention in a moment. So if we go on to the next slide, basically, and I will go somewhat quickly, this paper, the question that we pose ourselves is, do these post-2008 changing patterns in international financial markets affect the stability of bond flows to emerging markets? And basically, we look at three policy-relevant factors. One, we shift the focus from traditional pull and push factors to pipes factors. Again, remember all of the discussion. Fiscal dominance, balance of payments crisis, these were pull factors, adverse pull factors. Push factors, global financial cycle. So forget about these two, and then concentrate on what I was commenting, the nature of the players, which are global asset managers, the type of investment vehicles they choose, and how they trade. So these are, of course, pipes, variables that reflect the resilience of pipes and the interconnectedness. So we assess the impact of global asset managers, of debt markets exposure to ETFs portfolios, and changes in central banks' international reserves on the probability of extreme bond outflows. Those are the ones that we worry about. If you look at any central bank, small open economies, which has a healthy position in international reserves, a healthy macro stance, both fiscal and monetary, the thing that you have to worry about is conditions under extreme stress, because that's where you find yourselves in a situation where there is the possibility of extreme bond or extreme capital outflows. Very difficult to manage. So, and third, we explore whether central banks' liquidity provision under conditions of stress attenuate the link between these global factors and bond flows. So we go and we basically follow a research design based on two main building blocks. Let me not bore you very much with this. So we use a growth at risk model, and basically we look at the bond flows at risk, which we call the left tail last quantile, that is the 5% left tail of the distribution of capital flows. And then we look at the database on macrofinancial variables for the economies that I was mentioning, which is Brazil, Chile, Colombia, Peru, and Mexico. And basically the reason we do this is because these are the countries that have 10-year bonds. They have had so for about 2 decades. Argentina also used to have long-term bonds. Now the case of Argentina is very different, as most of you know. So we concentrated on these, the biggest Latin economies that have these instruments. And now let me very briefly show you how we use these variables. In the slide, you can see the weekly bonds at flows, bond flows at risk for the estimation for Mexico as June 2023. We use standardized bond flows to have a better interpretation, to have ease of interpretation. So, for example, the standard deviation on weekly capital flows in the case of Mexico is close to $120 million. So instead of, in terms of their standard deviation is 1.2, and in terms of the bond flows at risk in US dollars, that 1.2 is 143.3 million. So basically, this is what we're going to be looking at. What happens with the distribution of bond flows, in particular the outermost part of the left tail. That is the possibility of extreme outflows. And the sample spans from January 2004 to January 2023. And basically, the main variables that we use are weekly bond flows from EPFR. We use the VIX index from the Chicago Board of Trade. Then we, Chicago Board of Exchange of Options. Then we use the spread between domestic and US 10-year term premia. This term premia we obtained through methodology by Tobias Adrian, who was at the fund. This is a methodology that I think is now the standard one. And we publish at CEMLA basically the 10-year premia coming from this methodology for all of these countries on a weekly basis. And then we use the PIPE proxies that I was commenting about, the change in international reserves, share of non-resident held bonds, and the exposure to ETFs. And for another PIPE issue, which is the central bank's domestic and cross-border liquidity interventions. And I don't want to go very much into details. This is very simple. We have a panel regression here for every quantile T. We have country fixed effects. We have the VIX index. We have the term premium spread in terms of 10-year bonds. We have the non-resident bondholders, the share of non-resident bondholders. We have the change in international reserves. We have the exposure to ETFs. And we have, of course, an error return. And we have the data for all of these countries. So we use a panel regression exercise. And let me very briefly, I don't want to go into much detail, but I think that the results are very intuitive and easy to see. We shock the VIX index with an increase in one standard deviation, and we look at the distribution of capital flows. What happens here? The distribution shifts to the left, as would be expected. But the most important part is that if you look at the bond flows at risk, they increase from 1.2 to 1.46. The same happens if the term spread increases. That is, if in relative terms, the term premium in Mexico increases with respect to the US, we also have a shift to the left in terms of capital flows. And the bond flows at risk increase from 1.2 to 1.41. Next, we go to the PIPEs variables. We look at what happens when we have a one standard deviation shock as an increase in the share of non-resident bondholders, and again, the distribution shifts to the left. And the bond flows at risk increase from 1.38 to 1.67. If we shock international reserves by a decrease in international reserves, what do you think would happen? Of course, the distribution shifts to the left, and we have an increase in bond flows at risk. What happens if we have an increase in the exposure to losses in ETFs market values? Of course, the distribution shifts to the left. And again, the bond flows at risk increase. So basically, the results are an increase in the VIX and the term premium spread. They both shift, as would be accepted, the distribution of capital flows to the left, and the bond flows at risk increase. We have the results are in line with previous findings concerning the pull and push factors with the previous literature. And changes in PIPE's characteristics shift the expected bond flows distribution with the expected signs. I'm going to show you three exercises. This is the second one. Look at the panel regression here. It's the same, country fixed effects. We have the VIX, we have the term premium spread, but now we have the vector of PIPEs. And furthermore, we have the vector of PIPEs interacting with the VIX. And what are the results here? We see basically what happens, and we basically, in the scenario, the exercises change a little bit here. As it's underlined in the slide, we basically estimate three scenarios. An average baseline scenario absent of shocks, then one following a shock up to the VIX index for countries at the 25th percentile of the PIPE variable, which is in panel A, and then another at the 75th percentile of panel B. And again, compared to the average baseline scenario, if we look at the right-hand side, Looking at the case of the high share of non-resident bondholders, we have, if we shock it, if we do this exercise, we look at the distribution shifting to the left. Now, this is something that is very interesting. Why? Because usually if you look at even the G20 discussion in 2011, 2010, and so on, basically was about opening up our markets, and we wanted more intermediation, in particular our domestic markets, not the sovereign bonds that all of these countries issue. So the idea is that, of course, the more players, non-resident players that you have, you'll have a more diversified investor base. You will have a larger investor base. So it's basically everything good. Yes, but hold on for a moment. It also depends on the nature of the players, in particular under conditions of stress. So under conditions of stress, you see that if we do this exercise, at the end of the day, given the herding behavior, given the nature of the investments, given the concentration, given the possibility of crowded trades, we do have, if there is a large share of non-resident bondholders in domestic currency, we do see that the bond flows at risk do increase. But look at the other exercise. If we have a low share of non-resident bondholders, then we have the good result, in the sense that the distribution of capital flow shifts to the right. So very careful in the understanding these results in terms of macroeconomic management in these countries. If we go on to the next, we do the same kind of exercise, but in the left-hand panel for a large increase in international reserves, and the right-hand panel for the large decrease in international reserves. What happens here? What happens if you have the possibility of a large decrease in international reserves? Of course, the distribution shifts to the left. What happens if you have a large increase in international reserves? Of course, the distribution shifts to the right. So in the first case, bond flows at risk increase. In the second case, bond flows at risk decrease. And what happens in the third? That is the exposure to the market value of ETFs. Of course, in the right-hand side, you see the increases in the market value of ETFs investing in countries' bonds markets. It shifts the distribution to the right, but reductions in the market value of ETFs investing in countries' bond markets shifts the distribution to the left, as would be expected. So this is a big problem. This is a big problem because, of course, you want capital. If you go to the basic macroeconomic story, these kind of economies need capital to increase their consumption levels and to have a much more efficient consumption smoothing through time. You need capital. But the nature of that capital, you have to study it. Of course, the first step to do is you have to have good fundamentals. But even if you have good fundamentals, you will still have capital flow volatility. So you want to be very careful. It doesn't really matter the normal, let's say, cyclical capital flow volatility coming from the global financial cycle that you have. What you have to worry is when there are really conditions of stress in markets, like the Brexit episode, like the episode with the tantrum, taper tantrum, and so on. And in that case, you need a backstop. You don't have to worry about the fundamentals. You have good fundamentals. You have good monetary management. You have low stable inflation. You have a good fiscal stance. But you do need a backstop. If the market dries up, very complicated in terms of the possibility of having tremendous real effects in the economy. So what kind of backstops do you have? Of course, as you saw, using your own international reserves. That gives you a very important, again, incentive to accumulate reserves, which is costly. Or second, to use a backstop from a core central bank. And we use that scenario, and I show it to you very quickly here. So we have the same panel regression, but at this time we have the contra-fixed effects, VIX, the term premium spread, the pipes, and now we have the pipes interacting with the VIX. And what happens when we have a scenario when we want to compare, we have a shock, and either we intervene with a backstop or we don't intervene. We have, when we do intervene with domestic, that is with international reserves, look at how the distribution shifts to the right compared to the non-intervention case, which is the red distribution. The same thing happens, of course, with a cross-border intervention, for example, a bilateral swap line that, for example, Mexico and Brazil have with the US, or the FEMA repo facility that other Latin American countries have access to. It also shifts to the right. So let me very briefly finish saying with these two slides. One, in times of global market stress, a higher exposure to non-resident investors exacerbates the probability of extreme bond outflows. Large market value losses by ETFs investing in countries' bond markets are also associated with increases in the probability of extreme bond outflows. More liquid and resilient pipes are captured by the increases in international reserves, reduce the probability of extreme outflows, and liquidity provision under conditions of stress is crucial for these markets to be operating efficiently. And I finish with these remarks. Since the global financial crisis, complex market dynamics sometimes arise from perverse demand responses. Think about this, because this not only happens for different reasons in these type of countries' bond markets. Think about the bid spread trade. And basically, you have a situation where the increase in an interest rate, let's say long-term interest rates in the US, let's say the 10-year bond, it increases, of course, the price of the asset decreases. Under normal situation, what happens? Well, the price of the asset declining means that it's going to be attractive for somebody else to come and buy that asset, and the market balances. But what happens with this, for example, basis trade, where you buy US Treasuries in the spot market and you sell them in the futures market, and you try to take advantage of that very, very little spread? What happens, for example, if you leverage the buy leg of that trade? If the interest rate increases, somebody's going to want their money back, so you are going to be confronting margin calls. So instead of somebody coming and buying that more attractive asset, you will have the original trader trying to sell assets to meet the margin calls. So the first asset price decline begets more asset price declines. The same here, the same thing here. Because of the nature of the global asset manager, because of the crowded trades, because of the herding behavior and so on. Asset price decreases for different reasons in terms of how these pipes work, beget further asset price decreases instead of the market balancing. And these are very important, let's say, they've been called perverse demand responses. And you don't only see this type of thing in terms of market dynamics in EME's bond markets, but for example, even in the deepest bond market, which is the US Treasuries, happen with the basis trade. This can happen in other markets, for example, with the increase in long-term rates, the insurance sector. If they had, more duration on their liability side than their asset side, if the interest rate increases, certainly that duration comes in much quicker from the asset side, from the liability side than the asset side, and the insurance companies are left with too much duration. So they sell duration, and again, the interest rate will increase again. So again, there are situations in financial markets where asset price declines beget further asset price declines. And these type of dynamics are very difficult for macroeconomic management. And basically the result has been you do need at some point a backstop, as you had in the case of the US Treasuries, as you've had in the case of this, when these type of bond market dynamics have happened. So let me finish with this. This takes us to a very complicated situation where we see that if there are these backstops, then this type of, let's say, behavior, this type of complex market dynamics are exacerbated. You know that at the end of the day, if the market goes through a very stressful thing, a very stressful episode, and, for example, the recipient of these capital flows face a dried out market with the possibility of enormous consequences in economic activity and employment, they will use a backstop. And if you want to get out of that market for some reason, somebody will fund your exit. So at the end of the day, there are huge questions or huge issues here concerning moral hazard. And this is very difficult to address. On the one hand, you see that all of the fundamentals have been corrected, but for different reasons, dynamics in financial markets, in particular in bond denominated in domestic currency, can get very complicated. And then you need backstops. But if you do keep using those backstops at the end of the day, the behavior in these financial markets by the participants will become even more reckless. Of course, the solution would be to put redemption fees. But that's not going to happen. So we in emerging markets have to deal with this, and the way to deal with this is either with domestic interventions, either directly in the bond market or in the FX market, or through a cross-border liquidity intervention, for example, again, the bilateral swap lines or the FEMA facility. At some point, it happens that if these backstops are there all the time, then really let's say, the role of vigilantes, the role of market discipline by these participants is not there anymore. You can think also, you have heard of probably some people saying that we miss the bond vigilantes. The function of the bond market of disciplining macroeconomic management is not there anymore, because whatever happens, they know that there will be a backstop, that somebody will fund the exit. So that's a complicated part of the story in terms of the moral hazard. But you have been seeing, and well, if you follow some of these countries, that basically the use of these backstops, the liquidity provision, either domestic or through a cross-border facility in times of stress, has been crucial to stabilize financial markets and to permit these countries functioning properly. So that would have been the presentation. Thank you very much.
Thank you for having me, and maybe perhaps moving from the macro to the micro, I would like to talk about the effect that technology had in the US on financial stability. And about a year ago, you have heard about the regional bank crisis, and I would like to connect that crisis to technology. So, if I would ask you when was the last time that you visited a bank branch, I know that if I had to answer this question was, it's probably 5 years ago. And I'm sure that the answer is the same for all of you. A digital bank operates online and provides its customers the services that were previously available only at bank branches. Now, there have been recent technological advances in online banking, and we've seen them around the world, that enabled banks to attract deposits from and originate loans to non-local customers. That definitely benefits for the use of technology in banking, but today I would like to talk about the risks that are associated with digital banking. So in the US, we have several what we call pure-play digital banks. Think about SoFi, Discover, Marcus. But the online banks revolution goes beyond those pure-play online banks. It's not limited only to pure-play. Bank branch density, which is going to be defined, is defined in this paper as the number of bank branches to total deposits, has declined dramatically in the US. And the decline was fueled by a confluence of a 14% reduction in number of bank branches and almost a doubling of deposits in the US in real terms, adjusted for inflation. And during this period, banks with low branch density benefited from large deposits inflows, which led to even large branch density. So first, to see perhaps a picture of what happened in the US, you can see this blue line shows you the decline in number of branches. You can read the number of branches in the US from the right-hand scale. And the yellow-orange bar shows you the total deposits in real terms in the US, and you can see how they grew and how we got to a point where we have fewer branches and many more deposits. The large increase in deposits that you see starting in 2020 comes from the fact that because of COVID, households have increased their saving rates and consumed less, and also because that you had large government transfers programs to households. But even before COVID, you can see that there is a trend in increasing deposits and declining in branches. And you can see that the decline in the number of branches becomes steeper during the 3 years of COVID or post-COVID. And as we know, what COVID did was not to start anything new, but to accelerate some pre-existing trends. Here is another figure that can show you the blue bar is still the number of branches. The number of branches, by the way, in the US peaked in around 2009, and since then has been on the decline. This gives you a longer time series, and the red bar shows you the percentage change in number of branches. So two facts that you can see here. Deposits are increasing, branches are declining. Here is another way to look into that, and you can see this broken orange line, and what it shows you is, on average, how much in real terms does a bank branch brings in terms of deposits in the US, and you can see that in 2010, again, read it from the right-hand scale, it was about 100 million. One branch would bring you about $100 million in deposits. By 2020, it's more than 240 million. So that's coming from a time series regression in which we are trying to explain the amount of deposits per bank. The blue line shows you the R squared on those regressions, actually a bunch of cross-sectional regressions. And you can see that this is the R squared of branches in explaining deposit. And obviously, you can see that those have declined. So we have some other services that bring deposits to banks now. So the online bank revolution, number of bank branches in the US steadily increased until 2009, despite technological advances that enable digital banking even before. So it's not that we have this invention of the apps only recently. The technology has been in place. But starting in 2010, the number of bank branches declined annually, and the rate of decline accelerated over time. It was about 2% per year in the second half of 2010, and then it increased to about 3%. By the end of 2022, the number of bank branches reached its lowest level since 2000, about 80,000 banks, and that's roughly a decline from 80,000 branches, and that's roughly a decline from a level of about 100,000 branches in the US before. So let's first talk about what do digital banks do, and there is a question of how do you measure digital banks, and we will show you one way of doing it. But we have data on IT investment at the bank level, and we are going to classify banks. We also run it in a regression as a continuous variable, but I would like to present most of our results in terms of graphs, so it's going to be easy to follow them. So we are going to classify banks into 3 levels of IT investment, relative investment. And then I would like to show you how investment in IT here is investment in equipment, but also in software. By the way, for most banks, the investment on the software side dominates the IT equipment per se. And what I would like you to see is what type of deposits have grown and how have they grown in banks that invested more in technology. So what you see here is deposit growth, that's total deposits, and IT investment. And the blue dots represents the banks that made the largest investment in technology. The orange dot shows you those who are in between, and the green those who have made lower level of investment in technology or in IT. And you can see that total deposits have increased over time, and if the baseline year is 2010, have increased by about 200% by 2020. Sorry, by 150% by 2020 by those banks that had the largest investment in IT compared to the banks that had the lowest investment in IT, 50%. So it's about 100% difference between those type of banks. Now, this is for total deposits. As you know, in the US, we have, as many other countries, you have FDIC insurance, so deposit insurance. And now I would like to break it down between those deposits that are insured and those that are not insured, because there is an important distinction between the two. So here you see insured deposits. And you see in insured deposits, the growth rate, while it's still high, is not as impressive as what we have seen before for the total. So the blue dots that shows you, we also see the confidence intervals, but the blue dots that shows you the deposit growth by those banks that invested most heavily in IT have increased by about 100%, and those that invested less, those are the green dots, are about 25%. Now, if we move to uninsured deposits, now you see a much more impressive growth, and 200% is the rate of growth between 2010 and 2022 by those banks that invested mostly in IT. Those are the blue bars, and compare it to what you see for the green bars. So most of the growth in the US have been coming from uninsured deposits. In the US, used to be 100K as the limit on deposit insurance before the global financial crisis. Then it increased to 250, and that's coming from 2 sources. One of them is, of course, households that have more cash, but also from corporations. As you know, the saving rate has increased, not only for households, but also for corporations around the world. US firms hold much more cash, and some of that cash manifests itself into those deposits, uninsured deposits that you see here. So again, you see that those banks that invest in technology, maybe we'll call them digital banks, are being able to attract funds from depositors who have more money. So when we say uninsured, it's above 250K per insurance, per deposit. So let me define branch density. It's going to be a very simple variable. It's going to be the number of branches that the banks have relative to deposits. We have the number of branches in the numerator because that some banks will have no branches. We don't want to put it in the denominator. There is a question on how to measure digital banks. You can do it based on the IT that we have, and I'll show you the correlation between the two. Some use it whether the bank has a very popular app, but you know, most of the large banks, and in the US you have many of them, actually have very popular apps. So we think that actually, even though this is a measure of the outcome of digital banks, which means that you have fewer branches and more deposits, it's a very useful measure, and I would like to show you a few facts about this measure. So first, let's see high-density banks. High-density banks would be banks that have relatively large number of branches relative to deposits. They follow the more traditional banking form. And you can see here the total number of deposits in billion. That's the first row. So for regions, it's about 160 billion. And then you can see different metrics, but all of those, and in the last column, you see branches per number of branches per $1 billion. Mostly those are smaller US banks, with the exception perhaps of regions, which is a larger bank, but you can see that most of them are between 15 to $40 billion in deposits. Those are the high-density banks, mostly local banks, smaller banks. The low-density banks in 2022 would include most of the names that you would expect to see there, that are large institutions that can harness technology for their advantage and have very large economies of scale. So you can see JP Morgan Chase with about $4 trillion in assets, or Wells Fargo with almost 2, or Bank of America, et cetera. And you can see that if you look into the last column and you can look into the number of branches per $1 billion, you see it's about 2 or 3 or 1. Those are the low ones. Now, what I would like to show you now, what we call the very low density banks. Those are the banks that had the lowest density, which means that they had the most deposits per branches. And for those of you who are familiar with the events of last year, you'll recognize some familiar names over there. Let me mention First Republic Bank, Signature Bank, Western Alliance, SVB's Silicon Valley Bank, and others. So it's interesting that you just use this very simple metric without knowing too much about technology, and suddenly you see some of those recognized names, or famous or infamous names that by now. So the evolution of branch density by bank size, the blue bar that you see there are the very large banks, and you can see that they have seen a huge decline in branch density, mostly because of the use technology to their advantage. They shut down branches, and they have those large investments in IT. So let's talk a little bit about what we have seen so far. Let's take stock of what we have seen so far. So the growth in deposits, bank deposits grew rapidly between 2010 and 2022. Banks with lower branch density have experienced higher growth rates in total deposits between 2010 and 2022. The very low density group exhibits the fastest growth rates among all of the three groups, while the low density banks grew faster than the high density group. So again, if we split banks into those density measures, those that grow most rapidly are those with the lowest branch density. And just to show you the numbers, here's the cumulative growth of total deposits. Before I showed you the figures and I conditioned on investment in technology, now I'm splitting them into 3 different groups, which has to do with the density. And the blue, which is below, are the high density. The orange, which is low density, is slightly higher than the high, but the green is the very low density. This is SVB, this is or Silicon Valley, this is First Republic, et cetera, but not only of them. And what you can see is that those banks, even if we fix the branch density at the beginning of the period, those are the ones that are growing the most in terms of deposits. These are total deposits, but again, I want to show you that the growth rate is much higher for the uninsured deposits. Here is insured deposits. You see that the growth rate is about 60% for the green. Focus on the green dots. Those are the very low density. Here are insured, and now you get to 200%. So it's those banks that had the lowest density, and we will call them an extreme version of digital banks, are the ones that are attracting mostly uninsured deposits. Okay, when many observers of the banking crisis in the U.S. last year were focusing on the event, but the argument that we are making is that you have to first check what led to the events, and what led to the events was increase in or very high growth in deposits, especially uninsured deposits, that went to banks that somehow attracted them, mostly because of investment in technology, but also because of their ability to operate with fewer branches. So the banking crisis of 2023, over the course of 5 days, a year ago, 3 small to mid-sized US banks failed, triggering a sharp decline in global bank stock prices. And there are about several proximate reasons for the failures of these banks, including losses on bonds as a result from rising interest rates. That's probably a reason you have seen before. If you look into the paper, we control for that. Doesn't do much to the analysis, because our analysis is focusing on bank holding companies, and most of the banks that were affected by mismanagement of interest rates were very small banks. And also exposure to cryptocurrency, but again, those are not the root causes of the problem. The root causes of the problem is what I would like to describe now. So again, during the 2010s, and particularly starting 2016, US banks were able to grow their deposits with fewer branches. However, while banks with low and very low branch density were able to attract deposits inflows before 2023, they experienced significant difficulties during the first several months of 2023. And again, March 2023, you have 2 medium-sized American banks failed, Silicon Valley Bank and Signature Bank. And as a consequence, regional banks suffered large stock price declines in March and April. And eventually, a third bank, First Republic Bank, whose shares fell by 62% on March 13, 2023, suffered significant liquidity problem, which led to its closure and disposal of the assets to JP Morgan Chase. Many other banks suffered as well. Those are the main banks that sort of went bankrupt. So this is just a list of those 3 banks, and just I want you to pay attention to the fact, and I've shown it in the figure, that the last bullet point, the branch densities of Silicon Valley Bank, Signature Bank, and First Republic Bank were 0.1, 0.36, and 0.53, respectively, well below the 10th percentile of the branch density distribution, which was 0.7 in 2022. They are very different in terms of the branch density than the other banks. So banks affected during the 2023 banking crisis, here is the list, and First Republic went bankrupt, Pacific West or PacWest did not, but suffered. Signature Bank did. Western Alliance suffered. SVB went bankrupt, and Silvergate also had many issues. And in the last column, you can see their density. And the density is much lower than basically any other bank in the US. So they have much more deposits relative to very few branches, although none of them is defined as a pure play digital bank. Again, we have to change the way that we think about digital banking. It's not only pure play, because those tend to be small. Actually, this is how we propose to measure those, is deposits relative to branches, or branches relative to deposits. So branch density of the failed banks is just an illustration for you to see how they look like. Silicon Valley was stable over time, was always low density, but First Republic and Signature declined over time dramatically. So what happened? The decline in branch density, driven by both the decline in branches and the rapid growth in deposits during the years 2016-2022, contributed to the banking calamity in 2023. Clearly, multiple factors affected those banks. However, it is possible that the virtuous cycle of deposits growth that enabled these banks to attract deposits, largely uninsured deposits, became a vicious cycle once the bank run happened. So we have plenty of analysis in the paper, but I want to show you again one or two pieces which are very clear. So this is an event study that asks what happened to stock prices of banks on the day in which Silicon Valley goes bankrupt, goes bust. And on the vertical axis, you see over 2 or 3 trading days what happened to stock returns. That's on the vertical axis. On the horizontal axis, you see the branch density. And in the paper, of course, we run regressions. We run regression with controls. Here, we do not run any regression. Hopefully, you can see that there is a relationship between the two. And you can see in the bottom left column, those banks that suffered 50 or 60% declines include Silvergate, include Western Alliance, including Pacific West. Of course, we cannot have Silicon Valley because trading halted in Silicon Valley. This is the announcement when it happened. But it's almost as if the decline in stock returns line up along a line, and the lower is your branch density, the higher are the losses that you suffer. This is around Silicon Valley. Here is another graph. This is 2 weeks later when First Republic goes bust. And the magnitude of the effect is not as large because the information has already been priced, but you see that it's a continuation along the same lines where stock prices of very low branch density banks are declining more. Now, in the paper, we also have analysis of deposits flows and inflows and outflows, and everything is consistent. If you are a low-density bank, before the crisis, inflows are high and stock prices go up, and in the crisis, you have much more outflows and stock prices decline. And again, those are just scatter plots, but in the paper, you can look into a much more robust analysis. Okay, so what is the problem with digital banking? What's the issue with digital banking? And although digital banking helped banks in attracting deposits during booms, it may be a double-edged sword. Digital banking services have no geographical boundaries and provide convenience and speed that traditional in-person bank teller services cannot match. These features enable banks that rely on digital banking to attract potential customers such as corporations or tech-savvy or high-wealth individuals nationwide and gain a competitive advantage. Digital banking enables depositors to flee and swiftly move their deposits elsewhere when economic conditions deteriorate. Now, many people attribute it just to the fact that you have an app, and when you have an app, you don't have to run on the bank, you can run on your app. But having an app is insufficient, because in order to run, you need to have 2 apps, you need to have 2 banks. You need to be somewhat sophisticated, you have to pay attention. And the issue with digital banking is not technology per se. Technology is always good, almost always. The issue is the matching of technology to the type of the customers that you have. You see, banks do well when the depositors don't do much or don't act. The more sophisticated the depositors are, the more difficult it is for the banks to keep them in because they can always shop around, and especially when you have technology and you are not tied into one bank, into one branch, and you are not necessarily tied to the relationship that come with those, then you can move around much more quickly. So the argument that we make here is not about technology, it's about and it would be misleading to make an argument about technology. It's about the matching between the bank customers and technology. A stable bank is a bank that has some depositors who are not very sophisticated and stay there, and we like that. But what happens with digital banks, and maybe this is just a transition to the new equilibrium, is that the digital banks are attracting the most sophisticated depositors. And they are the ones who are fleeing and moving very quickly. Now, maybe we'll meet here in 10 years and every bank would be a digital bank and then we'll have a new equilibrium. But when we are transitioning to a new equilibrium, some banks are very digital, the others are not, what happens with the digital banks is that they attract all of the technology sophisticated, wealthy individuals, and that's not a good match for a bank. A bank needs to have some wealthy and sophisticated and some that are not. Actually, those who don't pay attention are the ones who gives you stability. So whenever you think about the transition to digital banking, you need to think about the matching of those consumers of those depositors to the banks. And here is a table that shows you who is the typical depositor based on the social demographics that we have in the vicinity, in the zip code of every, or the county of every bank branch. And bank branch density, low values means low density. So you want to flip the signs that you see here to translate them into low density. Low density, more likely to be in urban areas, more likely to have higher income, more likely to be younger, more likely to have high education. We think about those individuals as being the source of the engine of the growth for the economy. They are also the engine of instability for banks. Bank stability comes from those who are willing to leave the money, pay less attention to financial news, and are not obsessed with technology and know less about that. I'll push it and be a little bit more provocative. Making everyone increasing financial literacy is not necessarily leading to increased financial stability. Financial stability, and everyone in banking would tell you, comes from illiteracy, from the fact that funds are not moving around. So again, I'm not talking here about long-term equilibrium, but as a transition equilibrium, that's something that we have to be cognizant about. Just an example for some of the largest accounts in SVB, Silicon Valley Bank, the FDIC at some point released it and then retracted it, but we were able to catch it. So large firms had a lot of money. The issue is that those depositors are not only households. Those are also large firms. You can see here crypto firms and other firms that had large amount of money there. And they can move their money very fast. So the conclusion is we showed that the number of bank branches has declined between 2010 and 2022. The decline was fueled by a confluence of decline in number of branches and almost doubling of deposits. During this period, banks with low branch density have seen a higher growth, more investment in technology. That's another result that we have in the paper. I haven't shown you that. And have seen a growth in deposits. And, you know, I just want to make it clear here, it's not technology. Technology by itself is typically good. It's the matching of technology to the individuals that use the technology. And those individuals, you know, the smarter they are, the more sophisticated they are, the richer they are more likely to cause instability to the institutions where they deposit their money. So, you know, eventually, again, you know, trying to make a prediction, eventually probably we'll be in a different equilibrium where most banks would be much more digital than they are now. But if the population of depositors is going to be stratified almost evenly across banks, that's okay. If we have some banks that becomes pocket of those who are very sophisticated, those are likely to be the less stable banks. Thank you very much.
Thank you, Mr. Benmelech. Unfortunately, we are a little bit behind our schedule, so I think we will take only 1 or 2 short questions from the audience. Okay.
So I have one question, but it's A and B, so I hope that's okay. Actually, first a question for Manuel. So I was very intrigued by the policy discussion at the end. Fees, gates, I mean, that's a general discussion right now that we're having, right? I mean, some people would even go so far and say, maybe we need it for the banks as well, but well, I wouldn't go that far. But who would actually impose them? I mean, in the case of global asset managers, I mean, who would you actually think that you can impose these kind of liquidity regulations and possible tools? Then a question for Effie. So I really loved the presentation, very provocative. But of course, you kind of, at the end, you pointed out that the results on digital banking are actually driven by who are the depositors of the digital bank. So it's not really digital banking by itself, right? It's a kind of customers they attract and the tools that you provide them with. So that's where the digital comes in. But I mean, is the answer really to say, well, we should have less financial literacy? I'm not quite sure about that. I think that was a bit of a provocative statement, probably on your side. But I mean, or is it rather to say, well, it's a warning signals for supervisors. So to kind of look, for example, into who are the depositors of each bank. So not just saying, oh, there is this share of insured, of uninsured depositor, it's a geographic concentration or whatever, but also like, yes, what type of depositors are actually getting. And in the case, of course, of SVB, as we know, they were also linked with each other, right, so having the same kind of venture capital funders in there. So again, I think, because I mean, I mean, as an economist, we see a deposit runs in from two sides, right? We see the bad side, but you also see the good side. It's kind of a market discipline because ultimately, I mean, there were solvency problems in these banks, very obviously, and there were also management problems and so on. So again, I would strongly argue it's not really about having too sophisticated depositors, but the supervisor basically catching up with the sophisticated depositors and then also being able to intervene at a much, much earlier stage, which didn't happen in the case of the US. Thanks.
Want to go
first? So you're right. I'm not suggesting that you do not promote financial literacy, but it's an important point to understand that in the context of banking, ignorance is a bliss. And we have models that shows that, and we have results that show that, and that's true in general in terms of intermediation. And it's not a behavioral explanation, it's a rational explanation because it is costly to produce new information. And as long as banks are being viewed as being safe, then there's no need to produce information. I gave this presentation in a leading US university a couple of weeks ago, and a very important theorist told me it cannot be that depositors do not pay attention, and he insisted on that. And said that it's irrational, and he's a very rational person. I asked him, well, where do you hold your money? And eventually he said Bank of America, and I said, can you tell me what is the CDS spread of Bank of America? And the answer was that he didn't know what CDS spread was. So it's optimal for us not to collect information, and that's fine. And when you have people who are collecting information all the time, they are more likely to move funds. So first, the regulator needs to make sure that there is trust in the banking system, but also to make sure that you don't have too much of a concentration of depositors who can destabilize the banks. Thank you.
Who would post the fees? Well, the funds, but there's already been experiences in 2008 when they're, tried to use some mutual funds which were facing redemptions. What happened? Even more panic. So they're not going to, that's why I mentioned they're not going to put it, but giving, when your portfolio has 10-year bonds, giving immediate liquidity back, there is an externality for the country who are issuing those bonds. So basically, who is paying for that externality? The countries that issue bonds through having to accumulate reserves, which is very costly, or through accessing one of these liquidity facilities with the core central bank, like a swap line or the FEMA repo facility. What would be the best? Of course, there would be redemption fees, and you internalize there at the fund level the externality of giving immediate liquidity. But as I said, it's not going to happen. Difficult to think that an authority would, put fees on redeeming, liquidity from those funds. So basically, the cost is going to, and I think that these countries have to face the reality. They will be bearing that. I think that's not the most worrisome from the point of view of policymakers. The most worrisome is not, you have to live with that. You have to have international reserves for liquidity provision. There are many cases where the central banks have intervened. I think they're happy to do it. They're happy to pay the cost. The big problem, I think, is the moral hazard. Because the moral hazard that comes from there is that now anybody can come independently, whether you have good fundamentals or bad. You always want to get some, interest rate differential. With interest rates being so low during the wake of the financial crisis, and now with also going down, and emerging markets having increased interest rates so much. But it doesn't matter what your fundamentals are. Everybody's going to come in because they know that they have a way out, a funded way out. So I think that's more of the problem than the what would be saved, let's say, in terms of not accumulating reserves to give the exit to investors because there are no redemption fees in their funds. So that would be the answer. Thank you.
Just a very brief question for Effie, because as I understood talk about geographical boundaries is that it is mainly true for countries like the US, and something similar happened in China for the local banks. And I was wondering, what is your conclusion for Europe, where countries are, the banking sector of different individual countries are a little bit more closed, but we usually try to be more open. So is it a risk to have a more united banking sector in the EU when these geographical boundaries were less important for customers and they can freely move the money?
So you're absolutely correct that the evidence here is based on the US. I've looked into some other smaller countries, and I won't mention the names, and some of them have tried to promote competition in the banking sector by introducing digital banks. And the issue that I've seen is exactly the same, that the digital banks are attracting the tech-savvy, richer depositors, and it's fine. It doesn't increase the overall risk of the system, because that you're just reallocating or reshuffling depositors from one side to another. But whenever you create those pockets of concentrated, wealthy or tech-savvy or smart depositors in banks, you know that bank would not be very stable. So how do you solve it from a regulation perspective? I'm not sure, and I'm not sure whether we have the tools to do that. But a good bank is a bank that is stratified in a way that you have some depositors who are more likely to move or shift, but you also have a large depositors base that is likely to be stable and stay. So you want to have, that you'll have some dunes that would move away, but you want to have those mountains or those rocks that would stay there. And even in smaller countries, you see it in digital banks, much more than in traditional banks.